Hey guys and gals, my weekend video real quick here. Some things I'm looking at here for targets. So basically this is the Andrews Pitchfork we're currently trading in, okay? And so basically we did look below, we are looking below the midline here on our trend, okay? And we are testing the top of this longer term trend channel. The measured expected move from the all-time highs using this Andrews Pitchfork would suggest that we could be going down to 3,200 on this measured move layout. I have been calling for 3,400 by the midterms, which are not out of the cards. I mean, it's definitely a possibility. That's 200 points this next month possibility. Not saying it's going to happen, but definitely a possibility here. This channel right here, if I go out here on a longer time frame, I got 10 years right there. Let's go out 20 years. So basically, we've been in that channel since the '07 breakdown. Okay. So we're basically the primary trend we had going into the '07 breakdown, the big correction in the markets. Okay. We are back testing that area right here, right now on our primary trend. So basically, anything through here is just what you would normally consider a normalized correction off of the overall primary trend. So basically, all we have done so far is just give up the blow off top, and because of all the quantitative easing going because of the COVID crisis. Okay, so you know there is plenty of room for ample downside pain here in the market. So be aware of that going forward here. And 1 hour here real quick on this chart. So basically what I got going on here on this particular chart, our next support down here, which has not been tested at. This is one of our Andrew pitchforks. Um, so right down here, basically the 3550 3560 area is the bottom of our Andrews pitchfork. Okay, now let me show you a different view on my critical levels. Which one is it? I think it's that one there. Okay, I know this looks like garbage, but I actually use this to trade with, okay? And so basically, I draw trend lines to find unity points to where I can draw, at this point, I can remove this one because we have completely blew this one up. So I can take that off there to clean my chart up a little bit here. And hell, I can take a lot of these targets off too. Um, bottom line is I have been trading in much larger size here lately because of the volatility which I saw setting up over the past couple of weeks. Okay, the higher volatility. Now this week we are coming into a very tight uh, ranges on my trend lines. So I am thinking it might be a little bit more difficult, at least here at the first of the week, to get large range expansion until we were to start accepting prices below 35.60, in my opinion. So basically, this bottom trend line that gets you right back down that 35.60 area. So this is also suggesting that we could see that this week, a hard test of that, before we actually start maybe seeing some buyers show up in this market. But we start losing 35.60 and it really gets exciting there because then we are we're accelerating we are accepting prices into that 2007 breakdown area. Okay. And plus my fib arcs are extremely expanded here. So, we could be opening the trap door for, basically the 3,300 area, just with using my fib arcs in relatively short form. Or like I also mentioned, possibly 3,400 into the midterms. So be aware of that also. So, uh, you know, even 34.50 if we even get 34.50, this measured move area into the midterms, I'd be happy with that. But I've been calling this since January. So some things I'm looking at here. I have been trading in lot sizes for quick trades, 100, 200, 300 lot sizes, for the past few weeks. Seeing this cluster of trend lines now right below us starting this week, I'm not nearly as gung ho on my option sizing. Okay, going into this week, so be aware of that scenario. I think the real opportunity to be doing those really quick scalp trades in large size has been the past few weeks. I'm concerned that this week we may not have that opportunity. So be aware of that scenario. So I'm really rethinking of how I'm trading this week. Uh, honestly, I'm actually hoping that, we get some relief rally in this market, possible relief rally. And I think the real opportunity in any sizing would be to the upside. Okay. So that is my quick and dirty take. I don't think we can get, I don't know if we can get any upside, but I am saying, the risk reward, in my opinion, leans itself more to the upside than it does the downside until that 35.60 breaks, and then all bets are off. Okay, so that's just my quick and dirty look at the ES futures here. Another thing I wanted to look at here, and that's why I don't even know if I want to try the upside, VX futures. Okay, guys, and so basically what we got going on here, and let me find that chart. I got to show you something real quick here before I go into the VX. Okay, guys, real quick here on the market makers. These white boxes and gray boxes represent overshoots of the market maker move over the past several weeks here. It has been atrocious. If you're a market maker, you're you're selling, you're writing these contracts, and you're getting blown out because the probabilities have been exceeded on both sides. So what we saw last week, the past 2 weeks here, well, actually, last week we saw a big. If you go to your SPX here, uh, we saw a big expansion in premium that started last week and it continued into this week. If you go out, I don't know where is it? What is the end of the week? Well, yeah, 122. So basically, you got the same expansion, the same value as you had last week. So basically, starting last week, we started seeing expansion and volatility. So basically, what happened is, because of all this right here, this inventory just finally bled down to where eventually the supply was gone, and the only way to get the liquidity back into the option market, the VX futures started spiking. The premiums, the market makers started demanding more premium to write options. Okay, that started just last week, and it's continuing this week. And so now, if you go back over to VX futures, okay, so basically, what we got going on here is bull flagging. We are bull flagging here on the VX futures for a potential look above, and then they just might want to look above there and then fail. But my point is, the VX futures are telling us that we're probably not done with this down move, because typically what you see with VX futures, before the market bottom is finally in, you get a capitulation moment. And I don't think we have seen that yet, because the VX futures have not seen a spike. Going into that last move down in the markets, you typically see that's the last move of the VX futures to the upside. Okay, and we are not seeing that. We're seeing the markets go down lower, but the VX futures have not yet quite done that. So that suggests to me the markets are still going to go lower, because we have not had the capitulation moment where fear has grappled the market, you know. And so I'm very concerned of doing anything to the long side in this situation, knowing that we're bull flagging on these VX futures on the cusp of taking a big move to the upside. So be aware of that scenario going forward. Okay. And I want to keep my video short here, guys. So I want to mention that we had a Leman moment last week. So basically, we had a lack of confidence in the new British government. First thing that came out was announce quantitative easing and throw out the new corporate tax hikes, thinking that they were going to doing what they needed to do to save their economy. The markets did not like it at all. It drew up, it completely sopped up liquidity in the bond markets. And basically, the Bank of England had to do an emergency bailout of the gilts. So basically, it's the long end of the pension funding for most of England. And so basically, they came to the point there were no buyers for the gilts, and the lender of last resort, the Bank of England, had to come in there and do an emergency buy-up of the bonds to make sure that pension liabilities could be satisfied. So be aware of that situation. It was a Lehman moment, truly. If the Bank of England had not acted as swiftly as they did, we would be in one world of hurt right now, in my opinion, in the markets. Now the markets came down; they didn't break down. But my point being is, we would have been much earlier in the week down here at 3,600, the 3560 area, and we would have been closing the week out on the cusp of a full on onslaught breakdown in the markets if Bank of England had not acted as swiftly as they did. So be aware of that. The fear, what happened in England, it was such that the Fed decided that they have to have an emergency meeting Monday to discuss, the current market conditions, to decide whether or not they should do any type of changes in their policy. Uh, Unfortunately, in my opinion, you know, the policy they've got, in my opinion, has got us going in one direction. And if they rock the boat, from what the markets are anticipating here, it could even be perceived as even more negative. So that's a really bad problem they got. So basically, so a lot of people are coining the phrase Fed pivot. So we might have verbiage coming out early next week where they're going to say we're going to reduce the rate hikes to 50 basis points instead of 75 basis points. We're into we're going we're the rate of increase is probably going to be moderated in verbiage next week. Which I don't honestly think it's really going to matter too much. The markets are in a sell signal. We're really at critical supports here. Uh, Maybe they can save it. I am showing the UK markets. We closed right on critical support and we were really close to critical support, in my opinion, on the ES futures. Or SPX. We came down to 3,600, which is a really important number. But in my opinion, the 3560, that is critical on the ESs, the S&P futures. We start losing 3560, we are in deep trouble. Okay, and so we still have a little bit further downside here. Which could be a buyable dip here, but that I think the only reason they announced that Fed meeting is to make sure we didn't have some sort of uh, big gap down over the weekend and a margin call scenario for Monday. Because closing the quarter on the dead lows at critical support, this is not a good close or a good start for a new quarter. Okay, so a lot of people are thinking, oh, it's buy the dip, and as I showed you in those charts before, we're just at that point where what triggered the 2007 trend sell-off. We're right back to that trend area from the 2007 breakdown. Okay, that's where we're currently at. Okay, so it's not like you know, you can pretty much block out of your mind what happened where we were at. Okay, this is where we're at now. Okay, and I know a lot of oscillators are extremely oversold. So I don't want to discount the fact that we could have a decent short squeeze. I do not want to discount that possibility. Okay, I just want to mention that it just takes the wrong type of headline and things are just going to fall, just completely unravel. So, and there are rumors that there are some major credit financial institutions that are under extreme pressure right now internationally. A lot of people are thinking that we would have a banking crisis here in the States. Our banks are well funded. I think the contagion for further downside is international. I'm personally looking at SoftBank. It's in Japan. a SoftBank announcement of a major liquidity crisis out of SoftBank. Other people are thinking about Credit Suisse and Deutsche Bank. Both of them are significantly underfunded for this crisis. And as the if liquidity does not start rearing its ugly head here, where money comes in here supporting these markets, we're going to be, you know, it's going to get ugly real quick here. So just keep that in the back of your mind, okay, guys? So please like my video. Please leave comments below if you can. And honestly, my main takeaway going forward this week, I'm actually leaning to think we're going to start seeing some a Fed pivot, possibly a little bit lower rate of increase in yields, and then we're going to see people flocking to safety, possibly flocking to safety in the bond market, which will further in tune probably drive down equities. So be aware of that scenario. Okay. So thanks a lot for listening to my video, and please share them. I'm at Gumby9662C on Twitter if you're not following me, and I appreciate your time.